All right, guys, let's start. Okay, so today we'll study about your high-level summary of Basel III reforms. This is chapter number 23 of your operational risk. We are still doing your book number 3, operational risk, and we are now doing your operational risk chapter number 23, high-level summary of Basel III reforms. This topic only has one module, very small topic. That's all about your summary of Basel III reforms. And the point which I want you to understand, every one of you to understand, is that even though this is book 3, operational risk, right? Basel 3 reforms are cross risk. Right? These are cross risk reforms. Basel 3 affects your credit risk. Basel 3 affects your CVA risk, credit value adjustment risk. Basel 3 affects your operational risk. Basel 3 affects your leverage, your capital flows. So don't just think of this reading as operational risk. This reading acts as a foundation before you go deeper into your other kinds of risk as well. So operational risk framework, which we have studied. So that's what. And the message is very clear when Garp has introduced it here, right? They want you to note that if you want to understand operational risk better, right, you need to understand operational risk capital. And to understand the calculation of operational risk capital, you must understand why Basel III was revised and what exactly changed, right? So you need to have a good high level understanding of your Basel III reforms, right? So that is what we are trying to do here. That's what the objective is, and I hope you will understand that. Okay. So let's dig deeper, guys. Let's take it one step at a time. All right. Now, if you look at what all consists of module 1, right? So we have seven subtopics here. Basically, first we'll try to learn about motivation for revising the Basel III framework, basically why the earlier framework kind of failed. Then we'll go to the standardized approach for credit risk. That's what I told you, right? It's a cross risk, right? Basel III is cross risk, right? So we'll move towards your simpler, more transparent method, standardized approach. Then we'll also talk about your IRB, internal rating based approaches for credit risk. We'll talk about your reductions in reliance on your internal model. Then we talk about your CVA risk framework, which is credit value adjustment risk framework. CVA losses were a major blind spot in the crisis, which was understood in your Basel III. And then operational risk framework, where we are talking about exactly operational risk, replacement of your complex internal modules, internal models with your standardized measurement. Then we'll talk about the leverage ratio framework, which is a non-risk based backstop to prevent your excessive leverage. And then we'll talk about the output floor, which is we will limit how low capital can go due to your internal model, right? This structure uh, kind of, right? This structure kind of tells you the core Basel III philosophy, right? The core Basel III philosophy is don't put your too much faith in banks' internal models because that will bring your excessive variability. There is a chance of regulatory arbitrage, and that would lead to your systemic risk, right? So that is the whole point. We have already read Basel III little bit before this topic, so you have an understanding now that a lot of banks use internal models that brought a lot of variability in comparison of different banks, which a regulator didn't want. Regulator didn't want an regulatory arbitrage, and we wanted to kill this systemic risk, and that's why standardization came in the Basel III framework. Okay, all right. Moving on. Next one, as I told you, right, we'll talk about the motivations for revising the Basel III framework. The 2007-9 global financial crisis exposed major weaknesses in the regulatory framework. Your Basel II, what exactly failed in Basel II? Banks were well capitalized on paper, but still they collapsed. That was a big problem. Risk-weighted assets were severely underestimated, especially under your internal credit risk models, your CVA models, your operational risk EMA models. So when they used their internal models, they were manipulating, right? Banks were manipulating, and they were not standardized. There was huge inconsistency, same portfolio, very different capital across banks. So Basel II failed in your prevention of systemic risk, prevention of your banking failures, ensuring comparability of capital. And that's why, right, this is setting the background for why Basel III needed a rethink, not just an extension of Basel II, right? So that was the first point. In December 2017, the Basel Committee introduced final Basel III reforms. Note, this is very important for exam, right? You should know these are called final Basel III reforms, or sometimes people call it your Basel III endgame also. Sometimes people call it Basel 3.1. Implementation starts from 2022 onwards with phase timeline till 2027. The key phrase here is aiming to, right? Aiming to, meaning that it's a policy intent, right? And then what is the sub point here? Sub point here, basically, you are expanding robustness and sensitivity of the standardized approach. This will apply to your credit risk. This will apply to your severe risk. This will apply to your operational risk. What exactly this means? That earlier standardized approaches were too crude, not risk sensitive enough. So Basel III improves them so that they better reflect your underlying risk. Banks rely less on your internal models, and for operational risk specifically, right? This sets the stage for removal of your advanced measurement approach and introduction of a single standardized measurement approach, SMA, right? So that is what happened. Then if you go to the second point here, restriction in the use of internal model approaches. This is very, very central to your core Basel III philosophy. Internal models were very complex, were hard to validate, easy to manipulate. This is what was our understanding, and it resulted in capital arbitrage, not your genuine risk management. So Basel III said that we want to limit your internal rating based approach or usage for your credit risk, remove internal model for operational risk, restrict advanced CVM model, right? This directly uh, connects to your earlier topics also, and maybe later topics which will come ahead, to output floors and model comparability, right? Then next point is establish a leverage ratio buffer for GSIBs, global systematically important banks. Why leverage ratio? Because risk capital or risk weighted capital method failed, right? Banks were highly leveraged, yet RWAs looked low. So leverage ratio was introduced to act as a non-risk based backstop, right? Especially important for GSIBs due to your systemic impact. And this buffer is in addition to your minimum leverage ratio, must be met with your tier one capital, right? So that's what you need to understand. And last but not the least, introduction of your output floor, which linked directly to the internal model restrictions. Output floor ensures capital calculated using internal models cannot fall below a certain percentage of your standardized capital. So banks cannot say that okay, our internal models are so good that we can reduce our capital by too much, right? There is a floor, right, which has been said you can't go below that. And the purpose is to reduce your excessive capital variability, improve comparability across banks. So even if a bank uses internal models, capital cannot go too low, right? So that's what we have. And going ahead, if you look at the questions, right? So question here is the Basel III reform restricted the use of internal model approaches for all of the following risk categories except what, right? See, the key reasoning here is that Basel III talks about capital frameworks. We all understand. Systemic risk is not measured using your internal capital model, right? You can measure your credit risk, your operational risk, your severe risk, but not systemic risk, right? Systemic risk is addressed through what? Capital buffer. Systemic risk is addressed through your GSIP surcharges. Capital risk is Systemic risk is addressed through your macroprudential tools, right? So the correct answer here is systemic risk, right? So aware of that, FRM has a habit of testing such things. So you should be very, very clear, right? So answer is B. Right? This is what they have talked here, right? The use of internal models. The use of internal model approaches are restricted for credit, operational, or credit valuation risk, right? So that is what we have, right? This question basically tests your understanding of conceptual clarity and ability to distinguish between risk measurement versus risk mitigation things. Keep that in mind. Moving on, guys. Next one is another practice question. The Basel III reform introduced a leverage buffer ratio for all, right? So you have options from global bank, unregulated global banks, global systemically important banks, banks regulated by the US Federal Reserve and the European Banking Authority, right? So please keep in mind that leverage buffer ratio, right? Leverage buffer ratio is not a universal kind of ratio, right? It is specifically targeted at banks whose failures would threaten the system, right? So that is GSIB, right? Global systemically important banks that we need to remember, right? So keep that in mind very, very clearly. I don't think there should be an issue, and that is what your answer explained as well. Leverage ratio applies only to GSIBs, must be met using your tier one capital, right? And again, this ties back to what we have studied earlier, right? So overall objective is you have to prevent the systemic shock. You have to, it's a too big to fail problem which has to be addressed. Basel 3 uh, are not just about adding complexity, they are about removing blind faith in your models, especially internal models, strengthening your standardized measures, and placing hard backstops on leverage and capital, especially where there is higher chances of creation of systemic risk, right? So that's what the approach is. All right, fine. Let's move ahead, guys. Next one is understanding of your standardized approach for credit risk, right? So when you talk about the standardized approach for credit risk, please understand from the previous discussion we had till now, we realize very clearly, right, that excessive reliance on internal models created capital variability and arbitrage. So Basel III response was strengthening standardized approaches, not just restricting the model, right? So this is what we'll discuss here. And the point which is mentioned in this slide is that Basel III reforms enhance the standardized approach by increasing the granularity of your risk weight definition. What does it mean? It means that under Basel II, risk weights for broad and kind of not granular, so coarse, right? Many exposures with very different risk profile received the same risk weight. Basel III addressed this by introducing more buckets, more thresholds, and drivers for assigning more risk weights, making risk weights more sensitive to underlying risk characteristics. So, the key idea here is that standardized approach is no longer one size fits all. It is more differentiated now, right? So, for example, which is given in the slide is that if you look at Basel II treatment for residential mortgages, all residential mortgages often carried the same risk weight regardless of your loan size, the property value, the borrower leverage. Basel III changed it. Basel III said that risk weight now depends on loan to value ratio, right? If you have higher loan to value ratio, your higher risk weight. If you have lower loan to value ratio, you have lower risk weight. And this categorization, right, achieve two things, right? Better alignment with economic risk and regulatory capital, reduce your incentives to shift your risky exposure into standardized buckets. And this example is meant to illustrate your granularity, not your mortgage mechanics, right? So that is what we need to understand. So granular treatment across your exposure types is very, very important to understand. And Basel 3 extend this logic beyond your mortgages to rated versus unrated exposures, banks and corporates, residential versus commercial real estate, retail exposure, subordinated debt and equity, off balance sheet item. The important teaching takeaway is that standardized approach is now detailed enough to be a credible benchmark against your internal model, right? So this whole point directly links to what we studied earlier is that your output flow, right? Because standard capital becomes the reference minimum, right? So that's what we are saying that you need to have more value than that, right? Then the next point talks about reducing the reliance on your external credit rating. So under Basel II, right, external ratings, your Moody's, your S&P, and Fitch played a central role. This created some kind of cliff effects, right? Cliff effect means over reliance on your rating agencies or pro cyclicality. One is changing, everybody is changing, right? So Basel III reduced that mechanical dependence on the ratings and instead introduce your alternative risk drivers such as your financial ratio, your exposure characteristics, especially relevant for your unrated products and banks, right? So Basel III does not entirely eliminate ratings, right? But de-emphasize them, right? So that is the point. Please remember. And last but not the least, providing the foundation for the revised output floor means you are connecting basically uh, previous topic output floor. You were saying that why does your standardized approach matter for your output floor? Because output floor is defined as the percentage of standardized RWAs. If standardized approaches were crude or inaccurate, the floor would be meaningless. So Basel III says that first strengthen your standardized approach, then use it as a credible lower bound for internal model capital. This logical sequencing is very important conceptually, right? So that is what we need to understand. Okay, pay attention, guys. Next one, when we move ahead, is your internal rating based approaches for credit risk, right? So in internal rating based approach, what we are discussing is we are discussing the internal rating based uh, crisis performance. Means internal rating based approaches proved problematic during the financial crisis. The key issues which were observed were extreme complexity, that was one, lack of cross bank comparability, weak modeling of certain asset classes, example of structured credit. And in practice, two banks with identical portfolio showed very different RWs, right? So that is what happened. And when two banks with identical portfolio showed very different RWAs, supervisor could not easily challenge your outcome. And this directly justified your Basel III intervention, right? Now, when you talk about the advanced IRB, right? AIRB flexibility, under your advanced IRB, banks could estimate your probability of default, your loss given default, your exposure default, your maturity in some cases. This gave maximum modeling freedom, right? So that's a good thing for banks. But it also gave maximum scope for optimism, maximum RWA variability. And this flexibility is exactly what Basel III saw as a problem, right? Not a feature. So what they said or what they tried to do was that if you look at the foundation IRB, right? FIRB constraints. Under FIRB, banks estimate your probability of default only. LGD LGD, which is loss given default and exposure default, are supervisory fixed values. And why this matter? Because LGD and EAD are identified as major drivers of your RW variability, and fixing them improves your comparability across different banks, right? So this explains why your Basel III pushes banks towards your foundational IRB instead of your advanced IRB, right? And then we talked about the Basel III reforms to your IRB approach. This is the most exam relevant part of this slide. Basel III reforms kind of talks about removal of advanced IRB for certain exposures. ARB, advanced IRB is no longer permitted for large corporates or mid-sized corporates, banks, and other financial institutions. In these cases, banks must use your foundational IRB, FIRB, right? Not ARB, right? And there was introduction of input floors. Basel III imposes your minimum values for probability of default, your loss given default, exposure default purpose, and prevent your unrealistic low estimate, forces a kind of conservative capital outcome and more specific parameter estimation rule. Basel III, what they did was that they tightened the supervisory expectation, reduces discretion in your data selection, your downturn adjustments, your model calibration, right? So overall models were allowed, right? But only under strict constraint, right? So that is what happened in your internal rating based approach for credit risk. And then how did we move from AIRB to FIRB, right? Okay. All right. Now we'll test our knowledge with the practice question. The advanced internal rating based AIRB approach for credit risk will no longer be permissible to use under the Basel III reform for which of the following except, right? I told you, right? AIRB approach was or is removed for large corporate, mid-sized corporate, your banks and your financial institution, real estate are not removed, right? If you read the question, read it carefully. This is except question, right? It's the except question. So I told you, right? Your AIRB has been removed for large, mid-size, and banks, and right. So it's only for residential or the real estate exposures, right? These are not removed, right? So that is okay. That we understand now. So the exception is this one, option D. Uh, Keep that in mind, right? Very, very clearly. Basel 3 is a selective framework, not a blanket, because you wanted to have a niche kind of model, right, which cover every kind of risk. Okay, so overall, what you need to understand is that Basel 3 did not kill your internal model. It disciplined them, strengthened standardized approaches, and ensured that capital cannot drift too far away from economic reality or your peer comparability, right? That is what was the aim, right? So let's move ahead, guys. So this is what has been discussed here also. Okay. Next one is your understanding of your CVA risk framework. When you talk about CVA risk framework, the point to understand is that this is kind of a natural extension of the previous topic which we discussed, right? So if you look at the topic two which we discussed, that was about strengthening your standardized approach. Topic three was your constraint with internal models for credit risk phase. This is topic four, which is applying the same philosophy, but here we are specifically targeting your CVA risk, credit value adjustment risk, which kind of proved to be a major blind spot during the financial crisis of 2007-9, right? So what is discussed here is that CVA risk arises from your potential changes in the creditworthiness of your counterparties in derivative contract. CVA risk is not your default risk itself, but the risk that the market value of derivative declines because the counterparty's credit quality worsens, right? Even if the counterparty does not default, right? Even if the counterparty does not default, credit spread widening lead to your CVA losses. And what we need to understand is that CVA is a mark to market credit risk, not a realized default loss, right? So this is why CVA behaves more like the market risk than your traditional credit risk, right? Please understand that. Even though it looks like a credit value adjustment, but it behaves like the market risk because it is mark to market credit risk, not a realized default loss, right? And the next point is that it was a significant contributor to losses in the financial crisis, especially during the 2007-9 crisis. Many banks suffered large losses without counterparty defaults. Losses came from deterioration in your counterparty credit spreads, and there was large uncollateralized OTC derivative books, and this particularly exposed that CVA risks were undercapitalized. Existing frameworks underestimated its volatility, its sensitivity, and this directly motivated your Basel III intervention, right? So Basel III reforms which happened here were that Basel III reform to CVA focused on three key changes. All were aimed at improving your risk sensitivity, your consistency, your comparability, right? If you look at your what were the reforms? You incorporated market risk sensitivities and hedging instruments into the CVA framework. Earlier, CVA capital framework did not adequately reflect your sensitivity to credit spread, sensitivity to interest rates, ignored hedging benefit inconsistently. And Basel III explicitly links your CVA capital to your market risk sensitivities, recognizes your eligible hedges, improves your risk alignment. And if you look at very, very conceptually, CVA capital should respond to how your CVA actually moves in the market, right? So that is why it was done, right? And then you look at reform which happened, the next one, right? Remove the option to use IRB approach to CVA risk. This kind of mirrors what you saw in previous topic number three, IRB restrictions. Basel III eliminated the IRB style CVA capital, required banks to use a standardized SACB, standardized approach for your CVA or the basic approach. Why? Because CVA models showed high variability, CVA models showed poor comparability, CVA models showed limited supervisory transparency. So message was quite consistent that CVA is too systemically important to be left to unconstrained internal models. So that is what happened, right? And if you look at the last point, improve consistency with the revised risk framework. What does it mean? That Basel III kind of aligned your CVA capital with the revised risk framework, which was your FRTB logic, which you studied in market risk last chapter. And this is done by basing your CVA capital on fair value sensitivities, treating CVA risk similarly to your market risk factor. So CVA becomes a market risk capital charge driven by sensitivities, not your opaque models. And this improves your coherence across your regulatory frameworks, right? So that is what we need to understand, right? Again, typical, but yes, please try to remember it. Okay. Next one is understanding of your operational risk framework, right? So this is the core topic for FRM Part 2, operational risk, and um, everything else which you studied till now was building upon towards this, right? So here, if you talk about prior framework, which was your addition, advanced measurement approaches, or three standardized approaches. Under your Basel II, your early Basel III, banks could use advanced measurement approach, your three standardized approaches, right, which you studied in FRM Part 1 also. This framework or these frameworks failed in two critical ways. Failure one was that there was a capital requirement which was very insufficient to cover your bank losses. And the reality which was observed was that actual operational losses, such as your fines, your fraud, your misconduct, right, far exceeded your capital held, right? And this was very true for your large banks, your complex institution, your GSIBs, right? So despite your sophisticated models, capital was systemically underestimated, right? And this was failure number one. Failure number two was risk factors were not captured adequately in your internal models. Key operational risks during the crisis, such as your misconduct, your control failures, your weak governance, your inadequate systems. Advanced measurement approach models relied heavily on your internal loss data and scenarios and failed to capture your tail risk and your behavioral failures, right? So this exposed a very, very fundamental limitation. Operational risk is not easily modelable like your credit or market risk. And if you look at your the slide, right, you will see that there's a discussion about revised Basel III framework. Basel III response was very decisive and radical. Basel III replaced all previous model with a single standard approach, SA. The key idea was we don't need any advanced measurement approach, no alternative standardized methods. We want one approach for all banks to ensure your consistency, comparability, supervisory simplicity. And again, this kind of mirrors the broader Basel III philosophy we have seen across topics. And the second reform was that capital was based on your income and your historical losses. Basel III assumed two drivers of operational risk. One was your income, which said that higher income means more activity means more operational risk exposure, and income should be treated as a proxy for scale and complexity. And historical operation risk loss also to be considered because past losses kind of indicate weak controls and risk culture issue, which was very true in Credit Suisse demise. And loss history is assumed to be positively correlated with the future risk, and these assumptions are explicitly stated, right? Not hidden inside model, right? So that's what was the structure, right? So that is what we did. All right, guys. With this understanding, let's move ahead. Okay, so next is a practice question right now, right? If you look at the practice question, the new operation risk capital requirements under the Basel III reforms are determined by measure of the banks. What, right? We have options: leverage, income, income and historical operation risk losses, income and expected operation risk losses, leverage and expected operation risk losses, right? From the slide, we have read very clearly that capital is based on your income, first of all, and your historical operational risk losses, right? So no leverage, not model-based expected losses. The answer is income and your historical operational risk losses. Nothing about expected, right? We are saying history matters more, and income is the proxy for complexity, right? So income and historical risk losses, that is what we get, and that's what is what this the whole understanding here is, right? So if you move ahead, that is what your answer is also saying, that both income and historical losses are assumed to be positively correlated with your future operational risk, and expected losses are not used. So because your Basel want to move away from the modeling discretion, right? So overall, please understand that till now, right, just now we studied about CV and operation risk as area where your internal models failed most visibly. The response was not refinement, but standardization, your simplification, and conservatism, backed by your observable proxies rather than your subjective modeling, right? So that is what we are trying to achieve. Okay, all right. Moving ahead, and mm, next is the understanding of the leverage ratio framework, right? So what we studied till now, all the topics, this also ties to that. Up to now, we studied your risk-weighted capital failed due to model risk. We understood that internal models were constrained. We understood that the standardized approaches were strengthened. However, all of that relies on what? All of that relies on your risk weight, right? The leverage ratio is trying to answer only one question, right? What if your risk weights go wrong, right? The core idea of the leverage ratio is the leverage ratio is a non-risk based backstop, right? It ignores your risk weights and focuses on your absolute exposure size, prevents banks from appearing well capitalized while being highly leveraged, and this is why Basel III strengthens the framework rather than replacing it. Okay. So keep that in mind. And if you look at the points which are given in the slide, adding a leverage ratio buffer for your GSIFs that must be met with tier 1 capital, this kind of links directly to your systemic risk discussed earlier. The buffer applies only to your GSIFs, not your all bank. Because why? GSIFs create spillover or the contagion risk, right? JP Morgan, HSBC, all these banks, right? Therefore, they must hold additional loss absorbing capacity. And please remember that this buffer must be met with your tier 1 capital. It sits on top of the minimum leverage ratio requirement. So leverage ratio now works as the what? It's the minimum leverage requirement plus additional GSIB buffer, right? That's what we need to remember. And then if you look at the point number 2, which is given in the slide, defining the leverage ratio exposure measure, right? What exactly trying to measure? Earlier, leverage ratio definitions uh, understated exposure from derivatives or balance sheet item. Basel III refined this by better capturing your derivative exposure, your potential future exposure, your commitments and guarantees. Conceptually, the leverage ratio should reflect the true economic size of the balance sheet, right? And when we talk about it, right, this avoids your window dressing. This uh, kind of avoids your regulatory arbitrage through off-balance sheet activity. So that is what we are trying to achieve, right? Again, typical, but just try to understand. Next one is output floor. I think we have talked a lot about output floor till now. This is the kind of final integrating concept of your Basel III. If you uh, if you try to understand, this is one of the most core part, right? So please understand that when you talk about the Basel output floor purpose, right? Basically, objective is to restrict large banks from gaining unfair advantages. The problem was that internal models had lower RWs, right? Lower RW means lower capital, and same risk, very different capital across banks. The output floor prevents your RWs from falling too far below your standardized RWs. Effectively, you're setting a minimum capital requirement. This is not about banning model. It is about uh, bounding their impact, right? It is you are you're looking at keeping a minimum floor, right? The calculation method are, if you look at what is given in the slide, RWS equal the higher of, the ratio is given there, right? So basically RWS used for capital is equal to max of RWS from the banks. Approved approach is your internal or standardized, or your 72.5% of RW calculated using your standardized approaches, right? So you take the higher of that, right? Even if internal model produce very low RWS, the floor kicks in, right? 72.5% of your standardized approach, right? So you cannot model your way below the floor, right? The floor is 72.5% of your standardized approach, right? Uh, which standardized approach are used for the floor? So please note that here we are tying to the all earlier topics. Credit risk, we use the standardized approach for your credit risk. For counterparty credit risk derivative, we use the standardized approach for CCR for to measure your exposure, and then apply standardized approach for credit risk to the counterparty. This avoids your internal exposure modeling when computing the floor. For CVA risk, the floor can be based on SA CVA, standard approach CVA, or BA CVA, or your 100% of your counterparty credit risk capital. And critically, IRB CVA is not allowed. This kind of connects to what we said earlier in topic number 4. And then if you talk about your securitization risk, allowed options are SEC, ERBA, SEC, SA, or a 12% right? 1 to 50% uh, risk weight. This uh, ensure extreme conservative where modeling risk is highest, especially in the securitization products. And the market risk, standardized approach is permitted. Operation risk, standardized approach is permitted. And you also understand that the advanced measurement approach for operation risk was removed entirely. So that is what we understand, right? So you have to remember this, guys. This is little tricky. Please remember all these parts, right? This is not easy, but this is again a favorite topic of examiner, right? These are what happens for credit, market risk, operational risk, and other risk, right? Very, very important, right? Try to understand that. Okay, let's do the question now. The output floor sets the minimum level of what? It sets the minimum level of your leverage, your functional capital, your CVA exposure, the risk-weighted asset, right? From the definition, we know that the floor applies to your RWAs, not your capital directly. So correct answer is RWAs, right? So that we understand. Okay. Again, it's pure definition. If you know the definition, you will totally fine, right? Capital requirements are derived from RWAs. So by flooring your RWAs, right? Basel III indirectly floors the capital, right? Moving on. Next one is another practice question. Under your Basel III reforms, the approaches that can be used when calculating the output floor or CVA risk include all of the following except what, right? There are 4 things, right? The basic CVA approach, the standardized CVA approach, the internal IRB CVA approach, 100% of the bank's counterparty risk capital requirement. Again, from the topic which we studied earlier, the IRB approaches were explicitly removed for your CVA. The question asks you except, right? So except we know that IRB approach has been removed. So except we understand IRB, right? So answer is C. Again, pure definition. Please remember such things. These are important for exam, right? That IRB approach cannot be used for your CVA capital calculation. IRB approach cannot be used for your CVA output floor calculation. And this is kind of reinforcing Basel III's consistent stance that CVA risk is too important to rely on internal model, right? Overall, what you need to understand as a student who is preparing for FRM Part 2 is that uh, Basel III does not trust any single measure on its own. It combines your strength and standardized approaches, your constrained internal models, leverage, backstop, and an output flow, right? Together, this ensures the capital is conservative, comparable, and systematically robust, even when models fail, right? So that's what we need to understand. Okay, be very, very clear about this. All right. That's it, guys. That's it from this chapter. Go back, revise it, understand it. There's a lot to remember in this chapter. There are small, small things and very, very important for exam, right? Anything which is related to Basel, you obviously know that that is a very important topic for exam, right? So go back, revise it. Uh, please be aware of your small things, right? Again, I'll give you a quick recap. If you look at this topic, right, there are 7 things we need to understand. What is the motivation, the standardized approach, what is internal rating based approach, CVA, operational risk framework, leverage ratio, output. Everything is important. Your topic number 2, 3, and 4 ties up to topic number 5, 6, and 7. So first you understand 2, 3, and 4. Understand why did we need standardized approach? How did we move from your advanced IRB to foundational IRB? What happened in your CVA risk? Then what happened in the operation risk framework, leverage ratio, and output flow, right? Not a very long topic, but very important that you understand the conceptual understanding behind these topics. And you understand the logics, right? That is very important. And please do remember also, in spite of understanding logic, you must remember, like, okay, uh, what are the different weights, 12, 50%, right? So if you don't remember such numbers, it's very difficult to score marks in exam, right? Which approach is not allowed, right? Your, an IRB approach is not allowed for CVA, right? So you have to be very, very clear for such things in exam, right? If you don't remember such fine thing, right? Okay, CVA, the IRB, CVA is not allowed. Your basic CVA, standardized CVA is allowed, right? These questions will be very tricky in exam if you don't remember the exact rule, right? Which is important for a particular question. Okay, so go back, revise it. That's very important, and then I think you will be totally fine, right? So, all right, guys, that's it for this chapter. I'll see you in the next chapter. Okay, all right, thank you.